Ladies and gentlemen, we just had a meeting of the most powerful central banks in the world where they all met up at the European Central Bank conference and forum to discuss everything that's happening in the global economy, the global markets, what's happening with inflation, and where interest rates are going to go. I sat through and watched the whole 2-hour conference so I can take out the biggest pieces of information and the golden nuggets that you need to know right now. And guess what? A lot of people thought that these central bankers were going to come out like the Federal Reserve, the European Central Bank, the Bank of England, and be very dovish, but no, they were very hawkish. They came out and said, what is the markets doing? They don't know why the markets are pricing in cuts early next year. They're saying there's going to be much more pain coming ahead. And the way they were talking, it's almost like they want a stock market crash. Because some people may not know, but the stock market going up, house prices rebounding actually adds to inflation. It's called the wealth effect. People feel wealthier when their house goes up. People see their stock portfolio go up, then they sell their stocks, take the profits, and go out there and spend in the economy, and that makes inflation worse. And like I've been talking about, this creates a risk of a market melter. And I think the central banks are very, very aware of this, and that's why they've come out in this report. I'll go over this in detail with you, all the key information you need to know, and said there is going to be more rate hikes coming. So everyone, without further ado, let's get straight into the news, the facts, and the data. Well, look at this, everyone. Powell and central bankers see more tightening as economies withstand hikes. Now, a huge key topic, what a lot of central banks were shocked with, is how resilient the economy has been. But what I think the mistake they're making is the lag effect. They're completely unaware on how long the lag effect takes. It takes 6 to 12 months from when interest rates hit their peak, not from when they start lifting interest rates. But something they did address in this conference is very different today with, for the US, for example, we all know they've got 30-year fixed rate mortgages. But it's become a lot more common for Australia, England, and Europe to have fixed rate mortgages, which they didn't have in the past. And that's why when they're increasing their rates, they're not having the same speed of effect on the economy as it did before. But what I think they're not factoring in is there's going to be a lot of people coming off these fixed rate mortgages late this year, early next year, and even into 2025. So we're going to see a lot of people's mortgage payments skyrocket, in some cases double, and that's going to have a huge downward pressure on consumer demand. So listen to this. Appearing together in Portugal, Federal Reserve Chairman Jerome Powell, European Central Bank President Christine Lagarde, and Bank of England Governor Andrew Bailey all said they had ways to go in reining in too high inflation. Although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough, Powell said at the conference. That's exactly right, everyone, and this is what I think the markets are getting wrong. What they're pricing in is they're saying, okay, the Federal Reserve is going to hit peak interest rates at the end of the year, and they'll pause 1 month, and then they'll immediately start cutting interest rates at the next meeting. People, that's not going to happen. Jerome Powell said at this meeting, which we'll go into later in this report, that they don't expect inflation to go back down to 2% until 2025. And this is a great chart here of all the central banks in their rate hike cycle. We can see the European central banks at around 3.5%. The Federal Reserves are the highest at the moment, 5.25%. The Bank of Canada's up there at 4.75%, and the Bank of England's now at 5%. But of course, good old Australia is still far behind the curve at only 4.1%, and now with the latest inflation report coming in showing that inflation has dropped to 5.6% in Australia, but really what they're missing is it's because petrol prices dropped 8%, but in the latest CPI report, rents are still going up 8.5%, and food costs are still going up over 8%. And from the 1st of July, electricity prices around the country are growing to increase 25%. But I guess housing, food, and energy, they're not important. Really, people can be homeless as long as they got their smartphones, everything's going to be okay. Noting that most Fed policymakers expect to raise rates at least 2 more times this year, Powell left the door open to the central bank increasing borrowing costs at 2 consecutive meetings after it took a break from tightening at a gathering earlier this month. So even though core inflation in the US has fallen to 5.3%, they're still saying they're going to go to 5.75%. But you have countries again like Australia that still have inflation of 5.6%, and they're expecting no more hikes now. Again, for all my Australian viewers, there is still going to be at least 2 to 3 more rate hikes from the RBA, because if they don't, the Australian dollar is going to crash. Lagarde, for her part, suggested that an ECB rate increase for the next month was a virtual certainty, though she was less committal on what policy policymakers would do at the subsequent meeting in September. Bailey, meanwhile, vowed to do what was necessary to bring inflation back to 2% after the Bank of England surprised investors by boosting rates a half percentage point this month. And for all my UK viewers, I really do feel for you what's going on in your country. Inflation is still out of control, and I think the Bank of England rate is going to have to go to at least 6 or 7%. And again, unlike the US, a lot of mortgages, they're on adjustable rate mortgages or fixed rate mortgages that will be expiring soon. So we're going to see the UK housing market, they're definitely going to have at least a big correction or a market crash. But the central banks are a little puzzled, everyone. So if these central bankers, the most powerful central bankers, can't get it right, they have all, these economists working for them, this shows how hard it is to predict the markets and predict the economy. So despite fears what would trigger global recession, the world economy is so far held up, but underlying inflation has also been persistent. Now, another reason they're not taking into consideration why we're not in an official recession is because huge immigration right now. We're seeing immigrants flooding into the US, they're flooding into Europe, they're flooding into the UK, flooding into Australia. So if you actually did a per capita basis, I think the US, Australia, etc., most of the Western world will be in a per capita recession. And again, if growth is 1%, but inflation is 5 to 6%, in real terms, the economy is shrinking. It's only that the price of things are going up that's lifting the economy. Across the board, central bankers were saying we're determined, but I think they're a little puzzled that it has had little effect so far, referring to monetary policy. Speaking on Bloomberg Television, Rajan added, if you look at core inflation, yes, it's come down over the year, but it seems to stabilize, and that's a worry. That's exactly right, everyone. To bring inflation down from 8% to 5%, the first few percentage points is the easy part, but the hard part is going to get core inflation down from 4% to 2%. And it may not happen next year, like Jerome Powell said, this may take until 2025 or 2026. Powell and his Fed colleagues will get another reading on inflation on Friday with the release of May data on the PCE, that's Consumer Expenditure Price Index. And I'll definitely keep you updated when that comes out, but let's get into what markets expect it's going to be. And if there is a miss, if it's to the upside, we're going to see the market sell off. But if it is below expectations, we may see this rally go on for a little bit longer. So headline inflation on the measure is projected by economists to slow to 3.8% and 4.4% in April, in a large part due to a decline in gasoline prices, but core inflation, which strips out food and energy costs, which policymakers view as more indicative of the underlying trend, is seen coming in unchanged at 4.7% according to Bloomberg economists. So again, if core inflation doesn't change, it's going to show that inflation is much more sticky and rates are going to have to stay higher for longer. So now let's get into Powell's outlook. Powell said it won't be until 2025, like I said before, that core measures falls to 2% and voiced concerns that longer inflation stays higher, the greater the risk that it will become more entrenched in the economy. That is a big risk that a lot of people need to be worried about. Once the consumers expect the prices to go up, well, businesses will just keep on lifting prices because they'll say, it's inflation, and people just get used to prices going up 5 to 10% every few months. Then workers will demand higher wages. In Australia, minimum wage went up 8.7%, so this can create a wage price spiral. But Powell did warn the passage of time is not our friend here, and I completely agree. Powell acknowledged that a recession was possible as a result of Fed actions, though it's not his base case. But again, I think on a per capita basis, we are already in a recession and we could fall into a much worse economy than that. Others on the panel were equally cautious. While the Bank of England is not currently forecasting a recession, we have to watch it very carefully, Bailey said. I don't know about you, everyone, but I think if you ask most people in the UK, they will say it does feel like a recession. In the end, central bankers made clear that the number one aim was taming inflation, even if that meant economies would have to suffer through some tough times as a result. So everyone, let this just be a warning to you why the market is rallying on the AI hype right now. Economic reality is going to hit and hit very soon. But the economy has held up better even than I've thought, even though I do think we're in a per capita recession right now. But we won't feel the real pain until 6 to 12 months after interest rates hit their peak. So you're definitely going to want to prepare right now because more layoffs will be coming to start paying off debt because now interest rates are so much higher. If you've got debt with an interest rate over 7%, don't even start thinking about investing in the markets until you pay off that debt. Create an emergency fund because, like I said, there will be more layoffs. You don't want that to happen to you, but if it does happen, you will be prepared. Now, while the Federal Reserve has been more hawkish, this has caused the dollar to rise. That normally makes commodities like gold and silver fall in value. People think the economy, the stock market's doing a lot better. That's why we're seeing a recent sell-off in gold and silver. So I do think this is a good time to start dollar cost averaging back into silver. While everybody's running to stocks, you want to do the opposite. And if you're wanting to learn more about how to build wealth and master the cycles of gold, silver, and Bitcoin because I also think we're going to have a huge Bitcoin rally in 2024 at the next halving event. Well, you can click the link in the description below. My course is on a big discount right now, at $179. Most YouTubers charge $400 to $500 for their courses. I wanted to make it affordable for my loyal subscribers. Again, it's half price now, but once the course is finished, the price will be doubling. But everyone, what do you think? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.